8. Investing in real estate. Carpe per diem. Seize the check. Robin Williams. The homeownership rate in the United States was 64.2% in 2018. This rate differs contingent upon the demographics of households, such as ethnicity, race, type of household, and location. For some Americans, owning a home is a fundamental piece of the American dream that gives various monetary advantages, including the capacity to gather wealth and access credit by building home equity. If you have a mortgage on your property, you may be surprised to see your 30-year mortgage being paid off in 15 years if you were to prepay your next month's principal. If you are financially able to do so, next time you write your monthly mortgage check, write a second check for the principal-only portion of your next month's payment. Buying real estate is a popular way to invest and build equity. There are various ways of investing in real estate to build equity and create cash flow. Owning investment properties is a good method to make extra income while building home equity. Also, when you decide to sell, you could earn additional profit depending on the type of property that you buy and how you manage it. When you buy a property for investment, location is important because it will affect its appreciation and its resale value. Another way to build equity and create cash flow is flipping a property, which means you purchase it, make updates and improvements, and then sell it within a short period of time. If you sell the property within a year, you will pay ordinary income tax on the profit. However, when you sell an investment property after owning it for at least a year, you will pay capital gains tax on the profit. The single greatest asset that many individuals have is their home, and they may realize capital gains on the sale of their home. According to the current tax laws, if you are a homeowner, you are allowed to exclude up to $250,000 of your gain if you are single, and $500,000 if you are married filing jointly, provided that you owned and used the home as your primary residence for at least 2 years in the 5-year period before the sale, and that you have not excluded the gain from another home sale in the 2-year period before the sale. Keep in mind that if you sell your property within a year, you will pay short-term capital gains taxes, which are significantly higher than the long-term capital gains taxes, typically 10 to 15% higher. Therefore, to minimize capital gains taxes, and if you want to sell your property, sell after owning it for more than 1 year. It should also be noted that people in the lowest tax bracket usually do not have to pay any tax on long-term capital gains. Your capital losses can offset your capital gains. For instance, if you sell an investment property for less than its cost basis, you have a capital loss that can offset your capital gains. Savvy investors defer paying capital gains taxes by taking advantage of Section 1031 of the IRS Code 1031 Exchange. The aforementioned is an important rule to know because you can legally minimize and/or defer paying capital gains taxes. The IRS Code's Section 1031 makes it feasible for an investor to defer paying capital gains taxes on an investment property upon its sale, as long as another like-kind property is purchased with a profit from the sale of the investment property. A delayed exchange is the most common exchange type because the exchanger gets a lot of time to find the property and close it. For example, if an investor were to sell a property and receive $1 million in net proceeds, the investor will have to pay taxes on the gain. However, by utilizing a 1031 exchange, the investor may defer paying taxes and preserve all the profit from the sale of the property. The proceeds from the sale of the investment property are kept by a third party known as a qualified intermediary, QI. A third-party exchange is needed for a taxpayer to carry out the like-kind exchange, which is a powerful tax deference strategy used by successful investors. Any investment property other than your primary residence qualifies for an exchange. In summary, real estate is a good alternative investment for your portfolio, especially considering all the tax incentives associated with owning investment property and/or the tax advantages of owning a home. Of course, keep in mind that diversification is one of the golden rules of your investment portfolio.